In this video, we are talking about how the interest rate hikes have affected our local market so you know what to expect as a buyer or a seller or both when hopping into the market.
We're going to get started on that right now.
What's up, everybody? It's Cassandra Lopez with the Living in Bremerton channel. If you're new to the channel, you're going to want to go ahead and subscribe. This channel is all about living in Bremerton, whether you're relocating here for the first time, or maybe you've lived here before and you're coming back, or maybe you live here now and you just want to know more about it. Give me a call, shoot me a text, send me an email. This is my phone number and my email right here, and I'll be sure you are totally taken care of when moving to Bremerton. So if you haven't heard by now, the Fed has raised the interest rates 3 or 4 times over the last couple of months, and it has affected our local market pretty dramatically.
It's affected it huge, actually. So think about this. If you were looking to purchase a home, say 6 months ago, and you had the purchasing power of about $600,000, with the hike in interest rates, you know, you're looking at, for the same payment, $480,000, $500,000 purchase. So it's really affected things pretty dramatically. And this affects both buyers and sellers, obviously.
Yeah, so we're going to talk about the pros and cons of each. So that would have been a con if you're a buyer. You have less purchasing power. You can buy less house with the same payment every month. So now your payment has gone up for the house that you can buy. And if you wanted to stay at that $600,000 price point, your payment's going to be significantly higher.
Right.
The pro to that,
less competition.
Less competition, because all the buyers who are kind of on the fence or barely qualified with a stellar interest rate, well, now they don't qualify at all. So you have less competition. You have the buyers who don't want to pay those interest rates, and so they voluntarily got out of the market. So now instead of seeing, 8 or 10 or 12 offers on a house, we're seeing 2, 3. The activities
sometimes
really,
less than that. So think about this. So this is one way to wrap your brain around it. Is 6 months ago you're looking at a $600,000 house. Well, they're going to get 10 or 12 offers, like Sandra said, and that price is going to climb sometimes $50,000, $100,000. Well, now that $600,000 house may only get 1 offer, so it's not going to climb at all.
Right.
So even though the rates are higher and your payment is higher based on a certain loan amount, the amount that you're going to have to purchase for that exact same house may be a lot less. So it might kind of all balance out.
Yeah.
But the interest rate, it's just kind of a scary thing. We got really spoiled with virtually free money. I mean, when
that's
people
as
were
free
getting,
as you can get.
when people are getting interest rates for under 3%, I mean,
Yeah.
that's virtually free. So
free
now
money.
they're, floating around 5, 5.5. Depending on the loan product, of course.
To be fair, historically, that's still really low. It's just like Darren said, comparison this time last year, they're more than double.
We got really spoiled, and it's funny how we got so like, oh, this is the new norm, expecting it to last. And us in the industry, we know full well that 2.5% interest rates weren't going to last super long, and they may come back down again in a couple years, a year and a half. I mean, there's lots of theories out there, but
yeah, it's cyclical. They're not going to stay 5, 5.5, 6 wherever you're at forever. At which point you refinance into a really great rate, you lower your payment, and you will have earned all of that appreciation and all of that new equity in your house, sticking it out with that higher interest rate.
So as a buyer, there's the disadvantage. Obviously, you have a higher rate. The advantage is you're not competing as much, so maybe you don't have to escalate any, maybe none at all, and maybe you can even, gosh, I can't believe I'm saying this out loud, get a house for under list price, because that's been unheard of for the last couple of years.
The last 2 buyers I got into escrow over the last 2 weeks, both we got them below list price, which is like, you haven't seen that since 2017.
Now, transitioning to sellers, this is going to hurt sellers a lot more than it's going to hurt buyers. Sellers for the last couple of years, gosh, I mean, it was just a feeding frenzy. They put anything on the market and they just sit back and watch the offers come in. It made our jobs really easy on the selling side because we look like heroes. And
getting beat up on the buyer's side.
Getting beat up.
We're getting beat up right along with the buyers.
And so now we're telling all our sellers, they can't expect what was happening a year ago or 6 months ago. It's really changed, and it's changed really quickly.
Yeah.
So expectations as a seller, it's more important than ever to price appropriately. Don't try to get greedy. Have realistic expectations.
Absolutely.
Because
Listen to your agent.
Your buyer pool is way smaller.
We can't play the game where we price it a little bit over, market value, knowing it'll get attention. We need to price it right. It needs to be strategic, because the buyers that are out there, they can call more shots than they used to be able to, and they're gonna play the market. They're gonna play the games like, well, we'll just wait and see if it has any action on the review date, and if it doesn't, we'll come back and offer below list price. And that's exactly what's gonna happen. We're seeing listings that used to have a weekend full of showings, and these booming open houses get 1 showing, 2 showings over the weekend, because the sellers weren't ready to adjust those prices yet. And unfortunately, it just isn't the same market it was for 4 months ago. It's quite rapidly changed.
Yep. So just like Sandra said, real estate is cyclical. It evolves, it changes, it's all going to come around again, but it doesn't happen overnight, although it seems like the interest rates almost happened overnight.
Pretty much.
But so just be patient out there, and realize just the biggest thing that we like to tell our clients is to have realistic expectations. We're not going to tell you something just to win you as a client because it's something you want to hear, because we don't want you to be disappointed.
Right.
We want to set realistic goals so you can have, like I said, realistic expectations.
Well, and so the experience of buying or selling a house for you is easy, it's manageable. You may not get the money that you could have got 3-4 months ago, but at least you knew that, right? You knew that it was going to be a little bit quieter. You knew that it was going to be a little bit slower. 1 offer, 2 offers versus 8 or 10. And so then everybody's happy at the end of the day because, expectations were set and met. So that's kind of our goal.
And the one thing that's still working in the seller's advantage is we still do have a low inventory. There's still more buyers than sellers. The buyers aren't as powerful as they were, but they're still present.
Right.
And so as long as you do things realistically, price appropriately, your place will sell for sure. It's just not going to be the craziness that it was a few months ago.
Yeah, on paper, statistically, it's still a seller's market. And that just has to do with absorption rate, turnover rate, and all these fancy terms and stuff. But it's definitely flattening out, shifting. It's going to take us several months for it to get to a balanced market where there's an equal number of buyers and sellers and still enough inventory. I think that's going to be the linchpin. Inventory isn't affected by interest rates. We still have a low inventory. We still have a housing shortage. So even though maybe the economy will go into a mild recession because of this, the housing market will not. It'll still be a very robust housing market, according to all of the experts.
Well, it makes sense. The areas are still growing. Our population is still increasing. Construction isn't keeping up with that, and us here being in the military areas, we're having this constant flow of the people incoming and outcoming. So it's not like other places where the average homeowner's in their house 7 to 10 years. It's shorter here just because people come in, they're assigned here 2 or 3 years, and then they're shipped overseas somewhere else or across the country. So the turnover's faster.
It is.
And we're growing faster than we're building. So.
Which is great for our local economy. Our local economy is very robust, very booming. We tend to feel things in this area, farther down the road than maybe the rest of the country would, just because we have such a high military presence, and that probably goes for a lot of areas that have a lot of military, like San Diego and Norfolk and stuff like that. We feel the squeeze differently, and it's not as aggressive here just because we have that military support to keep our economy afloat. So basically it comes down to expectation, setting the proper expectation if you're a buyer or a seller, and listening to your agent, really leaning on to them and follow their advice, and you'll be fine. If you like that video, go ahead and give us a thumbs up. Tap that little bell so you're notified every time we drop a new video. Be sure to call, text, or email when you're relocating. I'll be sure to make sure.
That's a good one. She'll make sure to make sure.
Doubly sure.